AI could disrupt the job market. First Republic Bank finally collapsed, and Lyft employees to return to the office. All of these in this week's weekly business brief. AI will drive 83 million structural job cuts in 5 years. According to the Stack, artificial intelligence and other economic drivers will result in 83 million job losses over the next 5 years, amid structural labor market churn, according to the World Economic Forum's new Future Jobs report. The shift means that 44% of workers' skills will be disrupted in the next 5 years, WEF starkly suggesting in the 296-page report that generative AI models are likely to continue shaping sectorial shifts in employment. Okay, the fastest declining roles are clerical, secretarial roles, the report says. Traditional back office roles that the rise to AI means are rapidly being automated. An example of this week's IBM, where CEO Arvind Krishna told reporters that of his 26,000 staff working in the back office functions, I could easily see, and I'm quote, I could easily see 30% of that getting replaced by AI and automation over the next 5-year period. IBM cut approximately 5,000 roles this year, but created 7,000 new roles in Q1. So guys, what does this mean if you're in one of these occupations, right? These back office, like you said, secretarial jobs, as this report is saying. I think that it's important for us as human beings to reinvent ourselves. If you're in one of these roles that could be potentially threatened by AI, you need to start considering how you can reinvent yourself and create new skills for yourself so that you become valuable in the market. And AI is here. It's here to stay. It's not going anywhere. It's up to us to figure out a way on how we can use AIs to get what we want. In other news, the collapse of the First Republic Bank, reported by the Financial Times. The banking crisis of 2023 has claimed its largest U.S. victim to date. First Republic Bank, the deal regulators orchestrated in the early hours of Monday for JP Chase to acquire the California's lender assets and deposits in perhaps the best outcome that might have been expected in the circumstances. Sharing First Republic's loan losses with JP Morgan will limit the cost to the Federal Deposit Insurance Corporation to $13 billion. Yet, the failure of the bank was on the surface highly successful, and not engage in obviously risky activities is alarming. It underlines the need for all stakeholders in the banking system, investors, managers, boards, regulators, to find the flexible and imaginative ways to spot risk that may bubble up suddenly from changes in the trading environment. What First Republic shared with Silicon Valley Bank and Signature Bank, which failed in March, was a business model that did not adapt well to rising interest rate. Yet, while SVB's problems was its stock of mortgage bonds and treasuries, First Republic's issues were more in its loan portfolio, which is model of providing cheap mortgages to wealthy customers left it sitting on large paper losses on its mortgage book when rates rapidly climb. On the funding side, customers also began demanding higher deposit rates to keep their money at the bank. First Republic was more diversified than SVB's heavily tech sector dominated client base. The bank was facing a couple of years of poor earnings, but might well have survived had it not suffered a run on its deposits. This is a big deal. We are seeing some of the, I'm comparing this to 2008 in the fact, not exactly, but in 2008, we had a lot of bank failures due to subprime. This time around, we're having bank failures due to rapidly raising interest rates. And yet banks are failing as well. The challenge here that I see is that we're now creating a bigger monster with JP Chase, the biggest banker in the country. And now they're just absorbing more and more banks, and is giving them more and more power. And that creates a problem in capitalism. When they have a problem in the future, if they should have a problem now, it's going to be on the taxpayers' dime to bail them out, as it already is. But now we become, they're too big to fail. It becomes more of that mantra, you're too big to fail, we got to bail them out, because it impacts and hurts more working class Americans. This just creates a problem down the road, and I don't have the answer to what the solution to that situation is. But what I can say is that allowing the largest bank in our country to continue to buy more banks could be a problem. They could become bullies, they could dominate market share, and it just can create a major, major problem down in the future. Lastly, Lyft's CEO tells employees they must return to the office. This guy's sounding like Twitter CEO Elon Musk when he said everyone must come back or you go home when he bought Twitter. CNN reports that Lyft's new CEO, David Risher, announced another change for the ride-share company. Workers will soon have to return to the office. Lyft did not comment on the specifics of the plan, but the New York Times reported Risher informed employees they would be required to return to the office at least 3 times a week, Mondays, Wednesdays, and Thursdays, beginning after Labor Day. In an interview with the newspaper, Risher suggested remote work had isolated employees from each other, adding there's a real feeling of satisfaction that comes from working together at a whiteboard on a problem. I totally agree with you, Risher. I'm one of those guys that needs to be around other people. I think human beings, when we're a collective in a collective environment, human to human interaction, nothing can replace that. It's a polar switch up from Lyft's previous policy. Last month, the ride-sharing company announced it would become a fully flexible workspace, giving its employees a choice of where to work and live while strongly supporting in-person team gatherings. The announcement about returning to the office came a day after Lyft said in the SEC filing it would cut 1,072 employees, or 26% of its workforce, and eliminating 250 open positions. Risher said Lyft would significantly reduce its workforce last week, adding the layoffs were aimed at making Lyft a faster, flatter company where everyone is closer to our riders and drivers, according to an internal memo. And this has been your weekly business brief. I'll see you guys next week. And remember to like and subscribe to keep up with the latest business updates. Thanks for watching. Thanks for listening. Peace.